Competitive round 3. Let's see what happened there. We can start by looking at the selected financial statistics. I always kind of start at sales. I like to see what's going on there. And Chester, our computer team, still leading the pack, but Digby doing well, and Baldwin not so bad either. And when we look a little further, we look at the profits. What's interesting here is Digby had 187 million in sales, Andrews 145, and yet their profits are almost identical. 100,000, couple 100,000 or something. They're just about 100,000 even. Separating them, that's really an interesting number there. How do you have far fewer sales and yet have a profit that's actually a little bit higher? So we'll look at some of the numbers. Certainly it wasn't contribution margin. Digby had the higher of those, but SG&A to sales, on the other hand, Digby was much higher there, which, of course, there the lower sort of the better. I mean, in terms of absolute numbers, the lower the better. But you also need to continue to promote your products. So ROE, Digby much higher on the ROE, so pretty impressive, even though, again, it's a little bit odd, and so it tells you some things, and again, just looking at the selected financial statistics, I like to infer some things. If they have similar profits, okay, but Digby has a much higher ROE, what does that tell you? You have to know then. I mean, ROE is equal to net income divided by equity. So in that case, you have a much lower equity for Team Digby. Okay? Bigger sales but lower equity. We'll see why. We might make some assumptions, again, just looking at this. Look at Digby's leverage, 2.7 versus Andrews 1.6. So Digby is using a lot more leverage. And you can drive ROE, by using leverage, right? By keeping your liabilities up as compared to your assets, that's going to keep your equity down and drive your ROE up in that case. And so, these are things financial managers absolutely do, in the real world. Talk about, because return, to shareholders and return on equity, basically, it's if I'm a shareholder, the equity's mine. That's I get my portion of that, depending on how many shares I have. And so, one of the more important things I look at is that return on equity. Okay. The other thing I look at is my earnings per share. And here we've got a bit of a reversal. While up here, Digby, even though with a little bit less in profits, had a higher ROE. Again, their profits were almost identical, but here Andrews then has an earnings per share that's much higher, good 20% higher than Digby. And you'd expect them to be almost identical, except that Digby has sold, and one of your questions is going to be Digby has sold, about 400,000 additional shares since the start of the game. Okay, every team has except Team Andrews. Okay. So if we cruise down bond market and I had you guys look at that, talk about that in last assignment. We'll talk about it when we go over that assignment. So I won't spend too much time there at this point in time. Cash flows, Erie struggled mightily this time, and I've got at least one question kind of about that. And if you glance at it, you can see there are lots of inventory, and if I remember right, they had a lot of inventory after last round, and then they had a huge decrease in cash because they have even more inventory. Then we come along here and we see that plant improvements, only Baldwin and Chester are actually making plant improvements, and that is truly interesting. Digby has a positive there. What does that mean? Okay, what does it mean that Digby has a positive there? It means that they probably sold off some capacity. Okay, that would generally be the case here, where if you have net plant improvements, that's a positive number on the cash flow. It means you sold off some capacity. Okay. Sales of common stock, we still see teams actually, in spite of my admonitions, actually selling stock. You raise $1 million, $1.3 million there. You had $12.4 million in the bank. So you spent quite a bit of money. You diluted your shareholder base. You did a lot of things that would upset a shareholder. And for $1.3 million, which in this game isn't much, you got some long-term debt issued, retirement and current debt. No current borrowing except for Baldwin and Chester a little bit. Again, current borrowings, relatively cheap. Selling common stock, $1.3 million, is a very expensive proposition, whereas the current borrowing, to cover that amount of money, if you wanted that much for a cushion, borrowing money would be way cheaper than issuing that kind of equity. Issuing equity's got a lot of expenses, on and on. You pay advisors to issue it. You got to sell the stock. You got shareholders then that are demanding. Okay, and you've also diluted then your current shareholder base. Whereas current borrowing, in this game, and oftentimes in the real world, it could be a call to the bank. For $1.3 million, a small deal like that, probably just an advance on a line of credit, almost virtually no cost, other than a little bit of interest cost. So we got cash and decent amounts. Look at Ferris has got $42 million, Andrews 35, 30, 35, even Digby at 12.4. That's reasonable cash management compared to these other teams. That's a lot of cash. Okay, and here lies one of the questions. So, and it'll be a question on your homework. But I was talking about ROE and ROE for Digby's quite a bit higher. Okay, return on equity is quite a bit higher. And one of the components of equity is cash because it's a current asset, right? Okay, so it's a current asset. And one of the components then one of the components of equity is current assets, long-term assets, right? So they've got $70 million in total equity compared to $50 million there. And your question's going to be, jeepers, they're sitting on this much cash, which they really don't need. Could they have reduced their equity by getting rid of some cash? And we'll talk in the homework assignment about how you get rid of that cash in order to have an ROE that would be the equivalent of Digby. That's one of the points that I make. It's great to have cash in the bank. Don't get me wrong. Cash is king. You can do a lot of things. You can make investments. You can, especially if you have some plans for it. But on the other hand, it can also be a detriment. If you're a shareholder and the company you own has lots of cash and they're not using it for anything, you kind of want to get your cash back. It's your cash. You're the shareholder. You're the owner. So the income statement, again, one of your questions is going to come from there, and it's going to have to do with your EBIT, earnings before interest and taxes. And remember up above that, Digby has a much higher EBIT than Andrews, but then they both have about the same amount of profit. And the question might be, and will be on your assignment, is why. Still, other than Chester, just tons of capacity. We thought that perhaps Digby had gotten rid of some capacity. And we'll see Erie's using the capacity, but then also just has the tremendous amount of inventory on hand. What do we see? I should have looked at that up here on the balance sheet. Inventory for Erie. Look at that, $116 million in inventory. And one of the questions you might have for your assignment is going to be why. It'll be a little more specific than that, but if we look down here, otherwise, look at the Andrews, you wonder, they got lots of zeros there. You wonder if they may have had too many stock outs. Did they give up? So we'll have to kind of glance at the potential versus actual as we go down. If they didn't lose too much, it might be great that their inventory management was pretty good. Baldwin, pretty good inventory management, only in the size category, doesn't really have a lot. Look at Chester, low and traditional out, but man, oh man, that's almost perfect. Digby a little bit all over the place, kind of. Some categories obviously pretty good. Erie, just horrible, and we saw that. We knew that when we looked up above. Okay, and again, the question is going to be, why? I mean, they had lots and lots. They still have lots and lots of these, but they didn't sell. And why didn't they sell? We'll take a look at that. And Ferris, too, may well have, some stock outs in those areas that may have caused some losses in a sense. Baldwin here, look at that potential. So they gave up a lot in the traditional segment. Baldwin could have absolutely dominated the traditional segment. They just barely had the best sales there, but gave up, about 24, about 10%. That's pretty hefty. Okay, in that traditional segment. And a question you should always ask yourself is, why? Why did they or why could they have sold well? And again, customer buying criteria. So ideal age 2.0. Now there at the end of the year they were at 2.39, but that means that sometime during the year it was exactly 2. Okay, days may have been too young, right? Because it's only 1.5 years old. It's going to take a half of next year, right? Okay, in order to reach that 2. They spent a reasonable amount on promo and sales, but not too much. What's the other major thing? Price. Okay. Wow, look at that. They're still, right at the very top of the price. Boy, you'd have thought some of these other ones lower priced, and of course they sold out as well. Maybe a little less spending, a little less on the age, right? Not as close on the age. And then also look at cake, MTBF. And while MTBF's a small factor, it's still a 9%, and they're way down there, so that might have had an adverse effect for cake, which is the computer-run team. They're saving a little bit of money, but these teams might be selling quite a bit more. And then the performance and size. Actually, cake was well positioned there. Okay, a little bit better than Baker, okay? But not substantially better. So in the low, potential versus actual we did look at here. Here Chester had potential. Andrews, remember they had the stock outs. We talked about that. Ferris actually took advantage of that, even though they stocked out here in the low end. Pretty good cluster. You see a few traditional products selling in that area. Your number one seller with 5% over the number 2 seller is your computer team. Again, why is that? Well, perfect age, or just about perfect age, 7 is ideal, and they're 7.6. So again, they would have kind of passed through that during the year, so that's a big deal. That's the number 2 thing. Price is the main one, and look at that, lowest price other than Acre, and Acre did stock out. They had a little higher potential, so they did stock out. Their age is a little bit off, so high end. Oh, look at that. Andrews had all kinds of potential there, so again, a stock out, kind of hurt them. Baldwin kind of took advantage of that, as did Chester big time. But Digby did really well in the high end. They got a couple products. Remember, if you look above, they introduced a bunch of new products, and so that's very likely why. In the performance, again, Andrews, looks like they stocked out, gave up a bunch there. Chester kind of dominating there. Again, they got their product a little bit more to the front end, but followed pretty closely by Dot in terms of location, but then Dot maybe had some other issues, age a little bit off, the location, performance, you definitely want your ideal position. MTBF should be good. Position, prices there, and I think Dot's price, right towards the high end versus Chester, $3 less. Okay, similar product, $3 less. What are you going to go with? And same thing in the size. You see domination by Chester. So, one of the questions is here, why didn't Echo or Edge sell, and Eat sold almost none? Okay, sold 79 units in the traditional segment is what it amounts to. And why is that? Well, let's take a look at a couple things. We'll have to look at the perceptual map and see where they're located, but note their price is $39 and $34. Okay, I'm going to buzz down here in the perceptual map, Edge and Echo. I think Echo's hidden back there, but I think those are both they're located right here in the traditional segment. Okay, let's go back up and look at the traditional. Ooh, I can't. I'm going to give away the answer, and so I'm going to not talk about this anymore, I guess. But if you look at the traditional segment, just a hint then for the homework is, what's the customer buying criteria? You got 4 things. Okay, and there's some killers, right? If you don't, if your age were 8, in the traditional segment, you're not going to sell any. If your MTBF is below 14,000, you're not going to sell any. Okay, and if these things if your position's out of whack, you're not going to sell any. And so there's some killer things that absolutely destroy your ability to sell things in those categories. So. And you need to take a look at that, and you will for the homework. So I'm going to cruise back down. Sorry about that. The actual versus potential. I actually didn't ask any questions about that. I know I usually kind of hit that up. We look at the perceptual map. It's kind of important to note. We see, Digby with a couple of products in each category, but, one kind of leading and one kind of on the trailing edge. Is that okay, or would it be better to have them all up here on the leading edge? Interesting. You see Chester still pushing things, but followed pretty closely. And Andrews introduced a new product here in the high end, and so, Andrews is keeping up right there. And again, Andrews had some stock outs there that definitely cost them. They'd probably been pushing Chester on overall sales. Productivity index, so we see Digby spending a decent amount of money there, Erie a little bit, and Baldwin just a little bit, so not a ton yet. And TQM we don't do, and ethics I don't have that built in. So there you have it. It was a close round. I haven't even looked at the final score yet. I guess I should. I plugged it in. I think I know who probably was victorious. And we'll scroll on down here and see if we can find that. Gosh, that's painfully slow. Or maybe that's just me doing it to keep you guys in suspense. Ooh, okay. So for earnings per share, Chester, of course, but followed by Andrews as the student team. ROE, though, Digby then for the student-run team. So we've got a tight race here, just half a point off. And contribution margin, Digby won substantially, right? They were the highest of all the teams, followed by Ferris and Baldwin. And also they had a nice increase in stock price. And profits, however, Andrews eked out a victory there. And cash flow, Digby and Andrews were pretty close. Both beating Chester, actually. Strategy. Okay, so here we got it. Okay, Digby at 89.5 is in the lead. Andrews at 85.5. Let's see if there's any deductions, however. None for Digby or Andrews for emergency loan. Leverage. Digby got nailed for leverage. Oh, no. So Digby loses by 1 point. Again, that's a case where I think leverage can be a good thing. Leverage certainly helped drive Digby's ROE, but leverage also means risk, and that's what the deduction there is for. It's for the risk that comes with leverage. So Andrews is going to be declared our winner for round 3C. Congratulations to them, and good luck in round 4.